The number of AI-native customers are growing meaningfully with us as they see rapid usage growth with their products. Meanwhile, we saw consistent and steady usage growth in the rest of the business. We continue to see the overall demand environment as solid, with an ongoing healthy pace of cloud migration and digital transformation. And churn has remained low, with gross revenue retention stable in the mid to high 90s, highlighting the mission-critical nature of our platform for our customers. Regarding our Q2 financial performance and key metrics, revenue was $827 million, an increase of 28% year-over-year and above the high end of our guidance range. We ended Q2 with about 31,400 customers, up from about 28,700 a year ago. This includes about 150 new customers from our EPO and Metaplan acquisitions. We ended Q2 with about 3,850 customers with an ARR of $100,000 or more, up from about 3,390 a year ago, and these customers generated about 89% of our ARR. And we generated free cash flow of $165 million, with a free cash flow margin of 20%. Turning to platform adoption, our platform strategy continues to resonate in the market. At the end of Q2, 83% of customers were using 2 or more products, the same as last year. 52% of customers were using 4 or more products, up from 49% a year ago. 29% of our customers were using 6 or more products, up from 25% a year ago. And 14% of our customers were using 8 or more products, up from 11% a year ago. So our customers continue to adopt more products, including our security offerings. As a reminder, our security customers can identify and manage vulnerabilities with code security, cloud security, and sensitive data scanner, and they can detect and protect from attacks with app and API protection, workload protection, and Cloud SIEM. We are pleased that our security suite of products now generates over $100 million in ARR and is growing mid-40s% year-over-year. While we are pleased to achieve this milestone, we're still just getting started in solving customer problems in this area with new innovations such as our Bits AI security analyst. Moving on to R&D. We held our Dash user conference in June, where we announced over 125 exciting new products and features for our users. So let's go through some of the announcements. First, we launched fully autonomous AI agents, including Bits AI SRE agent to investigate alerts and coordinate incident response, Bits AI Dev agent, an AI-powered coding assistant to proactively fix production issues, and Bits AI security analyst to triage Datadog Cloud SIEM signals. To further accelerate our users' incident response, we announced AI voice agent for incident response, so users can quickly get up to speed and start taking action on their phones. We also announced handoff notifications that make it easy to jump straight into the relevant context and quickly communicate with our responders, and status pages to enable automatic updates for customers undergoing an incident. Second, we delivered a series of products to help customers ship better software with confidence. With the Datadog internal developer portal, developers can ship better and faster by gaining a real-time view into their software systems and APIs with the software catalog, by provisioning infrastructure, scaffolding new services, and managing code changes and deployments with self-service actions, and by following engineering and readiness standards with scorecards. We launched a Datadog MCP server to enable AI agents to access telemetry from Datadog and to act as a bridge between Datadog and MCP-compatible AI agents like OpenAI Codex, Cursor, and Cloud Code from Anthropic. We worked together with OpenAI to integrate our MCP server within the OpenAI Codex CLI. And the Datadog Cursor extension now gives developers access to Datadog tools and observability data directly within the Cursor IDE. Third, we are reimagining observability to meet our customers' increasingly complex needs. Our APM latency investigator formulates and explores hypotheses in the background, helping teams to quickly isolate root causes and understand impact without combing through large amounts of data. Proactive app recommendations help users stay ahead of growing system complexity by analyzing APM data to detect issues and propose fixes before they become problems. We announced a Flex Frozen tier so customers can keep logs in fully managed storage for up to 7 years and be able to search without data movement or rehydration. Archive Search now enables teams to query archive logs directly in cloud storage, like Amazon S3 buckets or in the Flex Frozen tier. And Datadog now supports advanced data analysis features within notebooks. Fourth, our security products cover new AI attack vectors across the application, model, and data layers. At the AI data layer, Sensitive Data Scanner can now prevent the leakage of sensitive data in training data, as well as LLM prompts and responses. At the model layer, we help secure against supply chain attacks in open source models and prevent model hijacking attacks. At the application layer, we help prevent prompt injection attacks and data poisoning in runtime. And finally, we showcase our new end-to-end AI and data observability capabilities. Engineers and machine learning teams can use GPU monitoring to gain visibility into GPU fleets across cloud, on-prem, and GPU as a service platforms such as CoreWeave and Lambda Labs. With AI Agents Console, enterprises can monitor the behavior and interactions of any AI agent used by their teams. We now offer LLM observability experiments to help understand how changes to prompts, models, or AI providers influence applications outcomes. We added a new agentic flows visualization to LLM observability to capture and understand the decision path of AI agents. And last but not least, and accelerated by our recent acquisitions of Metaplane, Datadog now offers a complete approach to data observability across the entire data lifecycle, from ingestion to transformation to downstream usage. So we continue to relentlessly innovate to solve more problems for our customers. In doing so, we are being rightfully recognized by independent research. And we are pleased that for the 5th year in a row, Datadog has been named as a leader in the 2025 Gartner Magic Quadrant for Observability Platforms. We believe that this validates our approach to deliver a unified platform which breaks down silos across teams. Now let's move on to sales and marketing. We had a number of great new logo wins and customer expansions this quarter. So let's go through a few of those. First, we signed a 7-figure annualized expansion in a 3-year contract worth more than $60 million with one of the world's largest banks. This company believes getting to the cloud is essential so they can use AI on their extremely rich data set to improve how they manage risk and serve their customers. They are using Datadog as their strategic cloud observability platform, and they continue to migrate more applications to the cloud. This customer is expanding to 21 Datadog products, with thousands of users who log into the Datadog platform every month. Next, we signed a 7-figure expansion to an 8-figure annualized contract with a leading U.S. insurance company. Datadog is supporting this customer's efforts to consolidate observability tools and expand their cloud-based products. By adopting Datadog, they are experiencing fewer and less severe incidents, with estimated savings of over $9 million per year in incident response costs and improving more than 100,000 customer transactions that would otherwise be impacted every year. With this expansion, this customer will adopt 19 Datadog products and will consolidate a couple dozen tools across multiple business units. Next, we signed a nearly 7-figure annualized expansion with a leading American media conglomerate. This customer has about 100 observability tools across more than 300 business units, and this tool fragmentation has resulted in inefficiencies in extra cost and lost engineering time. They are expanding to 21 Datadog products, including all of our security products, and replacing their paging solution with Datadog On-Call and incident management. Next, we landed a 7-figure annualized deal with a leading Brazilian e-commerce company. This customer's previous observability vendor was unable to support them as they moved to newer software platforms and modern cloud infrastructure. By replacing this tool with Datadog, the company was able to gain full visibility into its cloud tech stack and saw significant improvements in application stability and incident resolution times. This customer will start with 7 Datadog products, including Flex Logs. Next, we landed a 7-figure annualized deal with the delivery app of a major American retailer. This customer found our run and error tracking products to be immediately valuable, finding an issue on the first day of their Datadog trial that they hadn't identified after months of searching with their old tool. By adopting Datadog with 7 products to start, this customer will consolidate half a dozen tools while meeting their PCI compliance requirements. Finally, we welcome back a leading U.S. mortgage company in a nearly 7-figure annualized deal. This customer had moved to using a dozen open-source disconnected tools, which led to fragmented visibility, alert fatigue, and poor customer experience. In returning to Datadog, they plan to adopt 6 products, including replacing their paging system with Datadog On-Call. And that's it for another productive quarter from our go-to-market teams, who are now very hard at work on a busy Q3. Before I turn it over to David for a financial review, I want to say a few words on our longer-term outlook. There's no change to our overall view that digital transformation and cloud migration are long-term secular growth drivers of our business. As we think about AI, we are incredibly excited about our opportunities. First, AI is a tailwind for Datadog, as increased cloud consumption drives more usage of our platform. Today, we see this primarily in our AI-native group of customers who are monitoring their cloud-native applications with us. There are hundreds of customers in this group. They include more than a dozen that are spending over $1 million a year with us, and more than 80 who are spending more than $100,000. And they include 8 of the top 10 leading AI companies. While we know there's a lot of attention on this cohort, we primarily see it as an indication of what's to come, as companies of every size and every single industry incorporate AI into their cloud applications. And we continue to see rising customer interest for next-gen AI observability and analysis. Today, over 4,500 customers use one or more Datadog AI integrations. Second, next-gen AI introduces new complexity and new observability challenges. Our AI observability products help our customers gain visibility and deploy with confidence across their entire AI stack, including GPU monitoring, LLM observability, AI agent observability, and data observability. And we will, of course, keep innovating as the AI landscape develops further. Third, we are incorporating AI into the Datadog platform to deliver more value to our customers. As I discussed earlier, we launched Bits AI, SRE Agent, Dev Agent, and Security Agent. We are seeing very good results with those, with more improvements and new capabilities to come. Finally, as a SaaS platform focused on our customers' critical workflows, we have a large volume of rich, clean, and detailed data, which allows us to conduct groundbreaking research. A great example of that is our Toto foundational model for time series forecasting, which shows state-of-the-art performance on all benchmarks, even going well beyond specialized observability use cases. And you should expect to see more from us on that front in the future, as well as taking novel research approaches and models straight into our products to improve customer outcomes. So we are extremely excited about our progress so far, against what we expect to be a generational growth opportunity. In other words, we're just getting started. And with that, I will turn it over to our CFO. David?
Thanks, Olivier. Q2 revenue was $827 million, up 28% year over year, and up 9% quarter over quarter. Now, to dive into some of the drivers of this Q2 revenue growth. First, overall, we saw trends for usage growth from existing customers in Q2 that were higher than our expectations. This included strong growth in our AI-native cohort, as well as usage growth from the rest of the business that was consistent with recent quarters, amidst a healthy and steady cloud migration environment. We saw a continued rise in contribution from AI-native customers in the quarter, who represented about 11% of Q2 revenues, up from 8% of revenues in the last quarter and about 4% of revenues in the year-ago quarter. The AI native customers contributed about 10 points of year-over-year revenue growth in Q2 versus about 6 points last quarter and about 2 points in the year-ago quarter. Now, as previously discussed, we do see revenue concentration in this cohort in recent quarters. But if we look at our revenue without the largest customer in the AI native cohort, our year-over-year revenue growth in Q2 was stable relative to Q1. We remain mindful that we may see volatility in our revenue growth on the backdrop of long-term volume growth in this cohort, as customers renew with us on different terms and as they may choose to optimize cloud and observability usage over time. As you heard from Ali, we continue to believe that adoption of AI will benefit Datadog in the long term, and we believe that the growth of this AI native customer group is an indication of the opportunity to come as AI is adopted more broadly and customers outside the AI native group begin to operate AI workloads in production. Now, regarding usage growth by customer segment, in Q2, our year-over-year usage growth was fairly similar across segments relative to previous quarters, as SMB and mid-market usage growth improved in Q2, while enterprise customer usage growth remained roughly stable. Note that we are excluding the AI native cohort for the purposes of this commentary. And as a reminder, we define enterprise as customers with 5,000 or more employees, mid-market as customers with 1,000 to 5,000 employees, and SMB as customers with less than 1,000 employees. Regarding our retention metrics, our 12-month trailing net retention percentage was about 120, higher than the high 110s last quarter. And our trailing 12-month gross revenue retention percentage remains in the mid to high 90s. Now, moving on to our financial results. First, billings were $852 million, up 20% year over year. And remaining performance obligations, or RPO, was $2.43 billion, up 35% year over year. Our current RPI growth was in the low 30s year over year, and our RPO duration was up slightly year over year. As previously mentioned, we continue to believe that revenue is a better indication of our business trends than billings and RPO, as those can fluctuate relative to revenue based on the timing of invoicing and the duration of customer contracts. And now let's review some of the key income statement results. Unless otherwise noted, all metrics are non-GAAP. We have provided a reconciliation of GAAP to non-GAAP financials in our earnings release. First, gross profit in the quarter was $669 million for a gross margin of 80.9%. This compares to a gross margin of 80.3% last quarter and 82.1% in the year-ago quarter. As we've discussed in the last call, we saw an increasing impact of our engineers' cost savings efforts throughout this quarter as they delivered on cloud efficiency projects. And we are continuing our focus on cloud efficiency and believe that we have further opportunity for gross margin improvement in the second half of the year. Our Q2 OpEx grew 30% year over year, up from 29% last quarter. As we've communicated over the past year, we plan to grow our investments to pursue our long-term growth opportunities, and this OpEx growth is an indication of our execution on our hiring plans. Q2 operating income was $164 million for a 20% operating margin compared to 22% last quarter and 24% in the year-ago quarter. Within that, as we've noted, we held our Dash user conference in June, and as expected, the event cost $13 million. We also experienced a rising impact from the weaker dollar and absorbed $6 million of negative FX impact during Q2. Excluding those expenses, operating income would have been 22% in Q2, or 200 basis points higher. And now turning to the balance sheet and cash flow statements. We ended the quarter with $3.9 billion in cash equivalents, and marketable securities. And our cash flow from operations was $200 million in the quarter, after taking into consideration capital expenditures and capitalized software. Free cash flow was $165 million, for a free cash flow margin of 20%. And now for our outlook for the third quarter and the remainder of fiscal 2025. First, our guidance philosophy overall remains unchanged. As a reminder, we base our guidance on recent trends observed and apply conservatism on these growth trends. For the third quarter, we expect revenues to be in the range of $847 to $851 million, which represents a 23% year-over-year growth. Non-GAAP operating income is expected to be in the range of $176 to $180 million, which implies an operating margin of 21%. And non-GAAP net income per share is expected to be 44 to 46 cents per share, based on approximately 364 million weighted average diluted shares outstanding. For fiscal 2025, we expect revenue to be in the range of $3.312 to $3.322 billion, which represents a 23 to 24% year-over-year growth. Non-GAAP operating income is expected to be in the range of $684 to $694 million, which implies an operating margin of 21%. And non-GAAP net income per share is expected to be in the range of $1.80 to $1.83 per share, based on approximately $364 million average diluted shares. Some additional notes on our guidance. We expect net interest and other income for fiscal 2025 to be approximately $150 million. And due to the impact of the recent federal tax legislation, we now expect cash taxes for 2025 to be about $10 to $20 million. We continue to apply a 21% non-GAAP tax rate for 2025 and going forward. And finally, we expect capital expenditures and capitalized software together to be 4 to 5% of revenues in fiscal year 2025. To summarize, we are pleased with our execution in Q2, including the many products and features we launched at Dash. We are well positioned to help our existing and prospective customers with their cloud migration and digital transformation journeys, including their adoption of AI. I want to thank all Datadogs worldwide for their efforts. And with that, we'll open the call for questions. Operator, let's begin our Q&A.
Thank you. As a reminder, to ask a question, please press *11 on your telephone and wait for your name to be announced. To withdraw your question, please press *11 again. Please stand by while we compile the Q&A roster. And our first question comes from Raimo Lenschow of Barclays. Your line is open.
Perfect. Thank you. Two quick questions from me. Olivier, you talked about the AI contribution and slowly broadening out. How should we think about it in terms of when this goes much broader into inference, etc.? So does that everyone like Barclays, JP Morgan, etc., they all kind of need to do more around observability because they're going to do more inference, etc.? So in a way, like OpenAI, etc., is just setting the scene for future. And what do you think about the market opportunity there? And then, David, in the second half of last year, you hired a lot of extra sales guys. Can you talk a little bit about that ramp and where they are on their productivity curve? Thank you.
Yeah, on the AI opportunity, so there's really multiple layers to it. The first layer is largely what we see today, which is companies that are running their inference stack and their application around it in cloud environments. So that's the case of the model makers, or you think of the companies that are doing coding agents, things like that. That is what we see today. And it looks a lot like normal compute. So you have normal machine CPUs, some GPUs, quite a few other components, databases, web servers, things like that. So that's the bulk of what we see today. And there's going to be more of it as the AI applications come into production. There are more specialized inference workloads and even training workloads in some situations that rely on instrumenting GPUs. And for that, we have a new product out there that does GPU monitoring that we announced at Dash. But all that I would call the infrastructure layer of AI. Then on top of that, there's new problems in terms of understanding what the applications themselves are doing, and the applications are largely non-deterministic anymore. They either are run by a model that is non-deterministic by nature, or they're run in code that was not as carefully written as it used to be. It's not completely written by humans, it's largely written by AI agents. And as a result, you also need to spend a lot more time understanding how that code is working, and that largely happens in production. So that's a brand new area of observability, which is how do you deal with applications that have not been completely defined in development and that have to be evaluated in production. And what we think is the whole market is going there, not just the AI natives. The AI natives are definitely doing that today. Both applications are running on models and code that has been largely written by agents. But the rest of the market is going there. And the best proof point you see of that is the very, very broad adoption today, both of the API-gated AI models and of the coding agents, which you see in every single